In the period '09 through 13, the Fed took the Fed funds rate to zero to fight the global financial crisis, left it there a long time, and didn't have any luck getting it back up into what you might think are normal ranges. So we had a low interest rate environment, which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. You know, between 0 and 2 is an emergency measure. And, you know, rates were, the Fed funds rate was 0 much of probably the majority of the time in the '09 to '21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years. And it does subsidize borrowers and penalize lenders and savers. And I would like to see a Fed get to a neutral position, which is neither stimulative nor restrictive. And I describe that as 2 to 4. Well, we know that the leverage is in the government, that the government has taken on a lot of leverage as part of its rescue mechanism. We had 2 serious problems: the global financial crisis to kick off that low rate period you're talking about, and then the pandemic to bookend it. And in both cases, the Fed discovered something called quantitative easing, or the buying of bonds, and it really did a great job of saving the economy on both occasions, but it loaded up its balance sheet with debt. Well, first of all, I don't invest in sovereigns. And the trouble is that in sovereigns, other things matter. When we look at companies, we ask, do they make money? Will they make money? Will they be able to pay their debt?
Yeah.
Governments don't make money. They're not expected to make money, and they pay their debt by running the printing press. So that's a very different function. It's clearly worrisome. There's never been a bankruptcy of the U.S. or a country like it, so we don't know what's going to happen. Right now, the U.S. dollar is what's called the reserve currency of the world, and we get to print them. In the short run, we can print as many as we want. And as long as that's the case, we're not going to go under. It's like if you have an unlimited checking account, you can pay your credit card bills without limitation. We just don't know where it's going. That's the problem. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields, and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from '09 through '21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, you know, really